The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Examining the Opportunities and Challenges with Financial Technology, the Development of Online Marketplace Lending. Before we begin, I'd like to thank our witnesses for traveling here today to share your perspectives on this important issue. It is my understanding that we may be interrupted at some point for votes. I'll alert everyone that when votes are called, I will recess the hearing so members may vote. We will then resume the hearing once votes are completed. I ask unanimous consent that any full committee member who is not a member of the subcommittee be allowed to testify at the conclusion of the questioning by the subcommittees. I now recognize myself for 5 minutes to give an opening statement. Today's hearing is focused on the development of online marketplace lending. It's the first in a series of hearings on financial technology, or FinTech, that I plan to convene in this subcommittee. Online marketplace lending, sometimes referred to as peer-to-peer lending, has developed rapidly over the last decade. Leveraging technology, new lending platforms, and underwriting algorithms, marketplace lenders have provided expanded avenues of credit for consumers and small businesses alike. At the most basic level, online marketplace lenders provide a borrower with faster access to credit than brick-and-mortar lenders at loan levels traditionally not offered by banks. These lenders process these loans using online applications and automated underwriting that often allow funding decisions in less than 72 hours. Many consumer-focused lenders specialize in certain segments of lending, such as education loans, debt consolidation, or personal loans. Small business lenders are able to work with businesses to address cash flow issues and provide capital for growth and expansion projects. This type of financing is especially important given the depressed small business lending since the financial crisis. While certainly only a fraction of the $3.5 trillion in existing consumer debt, marketplace lending shows signs of tremendous growth potential and identifiable challenges. Over the last year, we have seen a growing attention paid to this market by federal regulators, the media, and other market participants. For example, the Office of Comptroller of Currency and the Treasury Department have considered the appropriate federal regulatory framework for these lenders. One proposal being considered would offer a limited national banking charter that could provide operational efficiency and regulatory clarity. To date, I have appreciated the measured and thoughtful approach taken by the OCC and the Treasury on these issues. Banks have grappled with the questions surrounding competitiveness and partnership. Some have been quick to point out an uneven regulatory structure, while others have embraced the opportunity to partner with lenders to leverage their technology and consumer reach. I'm hopeful that our community financial institutions will benefit most from these technological advancements and partnerships. Market analysts and the media have closely examined and scrutinized the market's development and anticipated where new growth or consolidation might occur. For example, there has been a significant shift from retail investor funding to institutional investor funding, which has facilitated the growth in originations. Some analysts estimate that the market will reach almost $90 billion by 2020. The improvement of capital markets is also seen in the securitization process. The market saw its first securitization in 2013, and as of today, there has been a cumulative securitizations of $10.3 billion. On the other hand, a 2016 report from Deloitte predicts that future of the market will see large consolidations and strategic partnership with traditional banks. To make better policy decisions, it is incumbent upon us to understand the business models and the product offerings of these lenders, understand how banks and lenders compete and collaborate, and finally, understand the current regulatory framework and how policy decisions may determine the market's future. I hope today that members will walk away with a better understanding of the market, its participants, and where we are headed. I now recognize the gentleman from
Missouri.
Georgia.
I got
Mr. Clay is here. I'm
here.
sorry.
I'm here, Mr. Chairman.
snuck up
I'm
on
sorry. We are playing musical chairs today, but we'll manage.
The ranking member is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to each of our witnesses for their testimony today. The promise of FinTech, or marketplace lending, is the ability to use innovation to improve upon the financial marketplace for the benefit of all stakeholders. That includes consumers and small business owners. that have often been underserved by traditional institutions in the financial services sector. At the end of the day, all of America benefits when our financial system ensures that access to responsible credit is non-discriminatory, transparent, and safe for business and individual consumers. Maintaining that type of financial system should also be our priority when thinking about marketplace lending. That means that FinTech or marketplace lending consumers must have clear access to transparent information about the products that they are receiving. That means that marketplace lenders also need to be transparent about their use of alternative data, provide consumers with the means for challenging the accuracy of that data, and ensure that the data does not discriminate against consumers based on protected characteristics. That means that FinTech investors must be provided with accurate info on the quality of the loans that they are investing in and the associated credit risk. And finally, that means that marketplace lending or FinTech cannot ignore the credit and capital needs of communities of color and women and minority-owned businesses. Innovation is important, and I applaud the marketplace lending sector for using innovation to expand the suite of financial products and services available to consumers. Going forward, it is my hope that your innovation will also extend to improving access to credit for underserved consumers as well. Thank you again to each of today's witnesses, and I look forward to your testimony. Mr. Chairman, I yield back the balance of my time. Mr. Scott.
Same thing, you good?
Oh, yeah, sure.
I recognize the gentleman from Georgia, Mr. Scott, for 2 minutes.
Thank you very much, Mr. Chairman, and I appreciate this opportunity to give an opening statement. I think that this new area of the financial system interacting with our rapidly changing technology is not only one of the more fascinating aspects of our economy, but is very definitively the future. We need not look any further than our last retail statistics, where in the last, I think it was 8 days before the Christmas holidays, 62% of all of the retail activity happened online. It's sort of like now we got the future right in our hands with the BlackBerry. And with this comes a lot of innovations, and it is important to me and to the state of Georgia because this is one of the fastest growing industries in the state of Georgia, and also because right now we have 71 million unbanked or underbanked individuals in our system. And we've got to make sure that they have access to credit. And we also want to make sure with the rapid innovations and the technological changes that are happening, that we move with caution to make sure that our policies that we put forward are neither overreaching nor underreaching, but that we reach that delicate balance. So, Mr. Chairman, I really look forward to this hearing, and with that, I'll yield back the balance of my time.
I thank the gentleman. Today we welcome the testimony of Mr. Paris Sands. He's the Chief Legal Officer of CAN Capital, testifying on behalf of the Electronic Transaction Association. Mr. Sachin Adhikar, General Counsel for Prosper. Mr. Rob Nichols, CEO of the American Bankers Association. And Mr. Bamal Patel, partner of the law firm O'Melveny & Meyer. And Mr. Garan Levi, Director of Policy and Government Affairs at the National Community Reinvestment Coalition. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, each of your written statements will be a part of the record. With that, I recognize Mr. Sands.
Thank you, Mr. Chairman Nagelbauer, Ranking Member Clay, and members of this committee. Thank you very much for inviting me here today at this important hearing regarding the opportunities and challenges regarding online and marketplace lending. My name is Paris Sands. I'm the Chief Legal Officer of CAN Capital. I'm testifying here today on behalf of my company as well as the Electronic Transactions Association, the leading trade association in the payments industry of which we are a member. Kane Capital was founded in 1998 by a woman small business owner. She struggled to access commercial loan products that would address her seasonal cash flow needs. And when she was unable to do so, she made it her cause to solve the issue of access to credit for small businesses. Now, some 18 years later, Kane Capital has the longest operating history in the space. Our risk and underwriting models have been tested and proven during the previous credit crisis, and we have provided small businesses with access to over $6 billion. We've served hundreds of different industries across the United States, from medical practices to restaurants to automotive shops. The proceeds of our products are used for business purposes, like hiring new employees, purchasing new equipment, and managing cash flow. As we all know, small businesses are the backbone of our economy. They account for half of the total workforce, and over the last 20 years, they account for 2 of the 3 net new jobs in the country. But despite their importance to our economy, these small businesses struggle to obtain the capital that they need to sustain and grow their businesses, especially since the Great Recession. In major surveys, small business owners report that they are often unable to access the capital they need through traditional small business loans. Part of the problem is that traditional financial institutions face high costs to originate these small business loans. It can cost as much for a bank or other financial institution to originate a $100,000 loan as to originate a loan for $1 to $3 million, making it uneconomical for these institutions to provide access to these small dollar loans. This creates an acute problem for Main Street because loans of $100,000 and less account for 90% of all small business loans. Fortunately for our country's underserved small businesses, new and innovative technology platforms are presenting alternatives to traditional small business loans and expanding access to capital. Online lending platforms like Kane Capital provide small businesses with fast and easy access to the loans they are seeking, loans of $100,000 and less, and loans of shorter duration that are often better suited to the operating needs of small businesses. With the help of our data-driven algorithms to assess the financial strength of potential borrowers, Kane Capital enables fast funding decisions in minutes and can deliver capital the same day or the next day. Our industry's approach to evaluating risk has expanded access to many underserved small businesses. This is because companies like Kane Capital use data-driven underwriting models that assess the financial strength of the business itself, as opposed to focusing solely on the FICO score of the business owner. As a result, we've been able to safely make available capital to many underserved small businesses that would typically be overlooked by traditional financial institutions simply because of a low FICO score on the part of the business owner. As the committee begins to evaluate the regulatory framework of our industry, we ask you to be sensitive to the risk that additional regulation of non-bank platforms could stifle innovation and possibly roll back the access to capital that platforms like Kane Capital have provided. Contrary to claims that online small business lending is unregulated, the industry is subject to multiple layers of federal and state regulation. Also, companies like Kane Capital that partner with banks become subject to a significant amount of additional regulation and supervision, both by the federal banking agencies that oversee the bank, as well as by the bank itself. Any additional regulation beyond this would certainly risk restricting small businesses' access to much-needed capital. Instead, we urge policymakers to facilitate further innovation in the small business lending space through a number of means. Encourage online platforms to participate in federal programs, such as the Loan Guarantee Program of the SBA. Encourage referral partnerships between online lending programs and traditional financial institutions to expand access to capital to deserving small businesses. Encourage industry self-regulatory efforts with respect to loan disclosures and borrowers' rights. And finally, support initiatives to create a harmonized policy framework that streamlines existing state laws for online lending. I'd also like to note that our industry and the small business community we serve are especially concerned about calls by some public officials to regulate small business loans in the same way as consumer loans. Commercial loans consistently have been regulated differently than consumer loans for multiple reasons, including the role of commercial credit as a driver of the economy and the sophistication of the users. As part of a thoughtful analysis, we ask policymakers to carefully study the important differences between commercial and consumer lending before making any decisions to conflate these vastly different categories. We applaud Chairman Nagelbauer, Ranking Member Clay, Small Business Committee Chairman Shabbat, and other members of Congress who have pushed back against these efforts in a recent letter to Treasury Secretary Lew. On behalf of the thousands of small businesses that we serve, we ask other members of Congress to please do the same. I thank the committee for the opportunity to testify, and I look forward to answering your questions. Thank you.
Thank you, gentlemen. Mr. Adekar, you're recognized for 5 minutes.
Good afternoon, Chairman Nagelbauer, Ranking Member Clay, members of the committee. My name is Sachin Adarkar. I'm the General Counsel and Chief Compliance Officer of Prosper Marketplace, and I'm honored to be here today representing Prosper. Prosper Marketplace launched in 2006 as the first U.S. marketplace lending platform. Our proprietary online platform connects borrowers looking for unsecured loans with individuals and institutions who wish to invest in those loans. To date, more than $6 billion in loans have been funded through the Prosper platform. The loans help people refinance high-interest credit card debt or pay for large expenditures such as medical bills. All the loans originated through the Prosper platform are made by WebBank, an FDIC-insured industrial bank under a credit policy approved by WebBank's Board of Directors. Prosper services all of the loans made through the platform. Prosper is the second largest consumer marketplace lending platform in the U.S. Some marketplace lending platforms, such as Prosper, offer investors the opportunity to invest in the loans made through the platform, while other platforms retain those loans and hold them on their balance sheet as investments. The Prosper platform offers borrowers access to fixed-rate consumer loans ranging from $2,000 to $35,000 with 3-year and 5-year terms. We facilitate a fast and transparent loan origination process that includes clear disclosures of all costs and fees and access to competitive interest rates. The minimum FICO score for eligibility on our platform is 640, and the average FICO score is 705. The most common reason for taking out a loan on our platform is to refinance existing unsecured debt, such as on a credit card, at a lower interest rate and on more affordable terms. Prosper uses mostly automated processes to verify the identity of borrowers and assess their credit risk. We've developed innovative technology to make these processes more efficient and effective. For investors, the Prosper platform offers access to an attractive asset class with steady cash flows and consistent returns. The estimated weighted average return on loans originated through our platform in June 2016 is just above 7.4%. In order to help investors make well-informed decisions, we provide them with a high level of transparency. At the time an investor is considering investing in a loan or a related security, we provide them with detailed but anonymized data regarding the borrower's credit characteristics. After an investor has purchased a loan or security, we also provide them with detailed performance data regarding the loan on an ongoing basis. We believe this approach creates an open and fair process for all participants in our marketplace. Loans originated through the Prosper platform are subject to the same comprehensive regulatory framework as loans originated through any traditional consumer lending platform. All loans must comply with the Truth in Lending Act, the Equal Credit Opportunity Act, the Fair Credit Reporting Act, the Patriot Act, and a host of additional laws and regulations. The loan program is subject to direct regulatory oversight by WebBank's regulators, the FDIC, and the Utah Department of Financial Institutions. The FDIC also has direct examination and enforcement authority over Prosper under the Bank Service Company Act. Additionally, Prosper is subject to the enforcement authority of the CFPB and the examination and supervisory authority of numerous state licensing bodies. Finally, the retail portion of our investor offering is subject to oversight by the SEC as well as state securities regulators. We've developed a robust compliance management program that includes strong controls, policies and procedures, and governance for all aspects of our operations. We're proactive in raising issues of potential concern with regulators, and we're committed to continuing this open and transparent dialogue going forward. We recently joined with other leading marketplace lending platforms to form the Marketplace Lending Association, which aims to facilitate this dialogue and encourage the responsible growth of our industry. We believe marketplace lending brings significant value to both borrowers and investors, and that it will play an increasingly important part in the financial industry in years to come. I want to thank you for this opportunity to provide an overview of our business and industry, and I welcome future opportunities to discuss these issues. Thank you.
I thank the gentleman. Mr. Nichols, you're now recognized for 5 minutes.
Well, thank you, Mr. Chairman, Ranking Member Clay. My name is Rob Nichols, the President and CEO of the American Bankers Association. The topic of your hearing, Mr. Chairman, is a very timely one. New technologies are quickly changing the way businesses connect with consumers. FinTech is a term used to capture this rapid convergence of banking and technology. While it has been used to refer to tech-focused startups, innovative technologies are offered by banks and startups alike. While these technologies may feel new, at their core they are leveraging technology to deliver traditional banking products and services. Make no mistake, banks are pro-innovation, pro-consumer, and very technology-focused. Banks have pioneered ATMs, credit cards, online banking, remote check deposit, etc. Banks continue this innovation today, investing billions of dollars annually to bring their customers the latest technology and channels. One such product, for example, was developed by a mutual bank in New England that recently announced its Express Business Loan, which allows small businesses to apply for a loan, get approval, and receive funding all online and in less than 3 minutes. Banks have a long history, of course, of serving customer needs and have established trusted relationships. These relationships are backed by a culture of compliance and regulatory oversight that ensures customers are protected. When innovative products are delivered through bank channels, customers get a great experience backed by a relationship they can trust. In addition, banks are actively partnering with FinTech startups to bring their customers the latest technologies. When banks innovate and partner with startups, their customers win. This is why the banking industry supports policies that empower banks and enable to innovate and enable them to partner. If they are better able to integrate these technologies, customers will have greater access to safe, innovative financial services. One way to facilitate this is to offer banks and startups a safe place to innovate new products. This program, often referred to as a sandbox or a greenhouse, would allow banks and startups to test real-world products that otherwise they would not be able to offer. Importantly, while the same rules typically apply to banks and non-banks alike, a lack of proactive oversight and supervision can mean that customers may receive inconsistent treatment from non-banks. Some have advocated adding consumer protections to small business loans to address this. We believe a better approach is to focus on the differences between the two that lead to very different outcomes, namely oversight. Problems that are emerging in the small percentage of online loans should not drive radical and unnecessary changes that risk impairing a market that has served businesses well for decades, point this gentleman made. Regulators are currently examining the potential of a federal FinTech charter to address this lack of oversight. As they examine this issue, we urge them to consider how any such charter would differ from a bank charter and ensure that it provides customers bank-level protections. It is important to note that while technology can drive innovation and add value, it is not a replacement for a community presence. Community banking is a relationship business that is not replicable by technology. While banks are driving technological innovation, they remain a visible presence, supporting their local communities, as they always have, through community outreach and countless hours of volunteering, something that cannot be done through a keystroke or an algorithm. FinTech technologies present tremendous opportunities for banks and customers alike. They have the potential to promote financial inclusion, giving greater access to financial services on better terms. These benefits, though, are only possible if we empower banks to innovate and partner with startups. A bank's investment in innovations today has the potential to benefit customers and businesses now and for many, many years to come. These innovations will only add value if banks, startups, and regulators can collaborate. Mr. Chairman, the ABA and Ranking Member, the ABA stands ready to work with Congress and regulators to help make this happen. Thank you very much for holding this hearing.
Thank you, gentlemen. Mr. Patel, you're now recognized for 5 minutes.
Chairman Nagelbauer, Ranking Member Clay, and members of the subcommittee, thank you for the opportunity to appear and to testify before you about the development of online marketplace lending. My name is Bimal Patel. I'm a partner and the head of the Financial Advisory and Regulation Practice at O'Melveny & Myers, and was formerly for 3 years a senior executive at the FDIC before I rejoined O'Melveny. Since returning to private law practice, I've advised marketplace lending platforms, banks, and investors on commercial and regulatory issues in this industry. According to the Treasury Department, in its recent white paper on online marketplace lending, and I'm quoting now, online marketplace lending refers to the segment of the financial services industry that uses investment capital and data-driven online platforms to lend to small businesses and consumers, end quote. Within this broad framework, marketplace lending business models vary considerably, focusing on different consumer segments with different operational and underwriting models. The online marketplace lending industry is growing rapidly. According to data reported by the California Department of Business Oversight, the aggregate volume of loan originations made by 13 of the largest online lenders grew from just under $2 billion in 2010 to just under $16 billion in 2014, which is an increase of 699.5%. While their business models and target customer segments can vary significantly, many online marketplace lenders share some common characteristics, including a user-friendly online experience, non-traditional sources of funding, a balance sheet light economic model, and alternative credit decisioning algorithms. Despite the industry's growth, it still constitutes a very small percentage of the U.S. credit markets, which encompass several trillion dollars. Thus, there appears to be substantial opportunity for the industry to grow. One key point of distinction within marketplace lending models centers on whether a particular marketplace lender partners with a bank in its origination process. Federal law currently permits banks to export their home state rate of interest to all borrowers, regardless of the state in which a borrower resides. Consequently, loans originated by banks whose home states have no effective usury limitation, a limitation on maximum interest rates, can carry higher interest rates than loans originated by other banks and non-bank lenders. Thus, some marketplace lending models depend on such a partnership to enable them to underwrite loans at rates that would otherwise violate state usury laws. As an alternative to partnering with a funding bank, marketplace lenders can engage in lending by procuring state lending licenses in the states in which they make loans, but these loans are subject to state law interest rate restrictions that vary by state and pose administrative and financial burdens that can be prohibitive to certain business models. Depending on the precise business model of a marketplace lender in the category of borrower to which it caters, a series of consumer protection, data privacy, securities, and anti-money laundering laws that I have identified in my written testimony are generally applicable to lenders either directly or indirectly through bank partners. Recent developments also indicate that the prudential banking regulators, CFPB, and state regulators are taking a keen interest in this area and that further regulatory developments are forthcoming. As I mentioned previously, there appears to be substantial opportunity for this industry to expand and to further economic growth and economic opportunity for U.S. consumers and businesses. This growth will be dependent on economic and commercial considerations, as well as state and federal policy developments. I thank the committee for taking an interest in these important issues, and I welcome your questions.
I thank the gentleman. And now, Ms. Levi, you're recognized for 5 minutes.
Okay, good afternoon. At the outset, I want
Get
to...
your microphone.
Good afternoon. At the outset, I want to thank you, Mr. Chairman, for convening this important hearing. Marketplace lending models certainly warrant closer examination and some congressional oversight. And Ranking Member Clay and others on the committee, I know you will be asking important questions about how marketplace lending models interface with the nation's traditional banking infrastructure. Our marketplace lenders, who are largely monoline financial service providers, structures in ways that will ensure that they are resilient throughout business and economic cycles. What is the nature of federal supervisory and examination protocols regarding consumer protections and fair lending laws and regulations? Whether interests across the various models are aligned so that FinTech players have the veritable skin in the game, so that they have a stake in ensuring that loans are underwritten well, ability to repay is paramount, and lending is safe and sound. Importantly, we believe that all the members of the committees should examine whether aspects of the industry's use of data, sophisticated but opaque proprietary underwriting algorithms, still insufficient transparency around pricing and loan terms, broker fee and compensation arrangements, and other features are evoking parallels to, the run-up to the crises around predatory subprime lending and private label securitization. My name is Jerron Levi. I'm the Director of Policy and Government Affairs at the National Community Reinvestment Coalition. NCRC and our 600 grassroots members, quite simply, are interested in creating opportunities for people to build wealth. We work with community leaders, policymakers, and financial institutions to champion fairness in banking, housing, and business development. I appreciate the opportunity to testify this afternoon. Though the industry is nascent, marketplace lending is a growing segment. When evaluating these online lending platforms and their sophisticated underwriting algorithms, NCRC certainly is interested in seeing how they can expand safe and sustainable credit. There is no doubt that innovative solutions are needed to address a fundamental issue. Small business lending is down, and businesses are not getting off the ground or are dying on the vine for a lack of credit. According to a recent Wall Street Journal report, the number of loans issued by 10 of the largest banks in the U.S. has decreased 38% to $44.7 billion in 2014, which is down from a peak of $72.5 billion in 2006. Importantly, however, we want to see FinTech and all innovation and marketplace lending that is safe and sustainable. Consumer protections and fair lending protection should not be different for the borrower based on where they apply for the loan. We have also long supported all lenders in the marketplace, including marketplace lenders, being covered by and examined under the Community Reinvestment Act so that low and moderate income borrowers and underserved communities, including rural communities, are receiving the full benefit of lending and innovation in the financial marketplace. We have grown concerned about some of the dissatisfaction reports we are seeing in the marketplace from our members and others. A recent survey of small businesses by several Federal Reserve banks reveals that 20% of small businesses obtaining credit used online lenders, with micro businesses using them to a greater extent. But their satisfaction with online lenders were very low. Online lenders received a score of 15 among firms approved for credit, compared to 75 for small banks and 51 for large banks. Small business lenders complained about the lack of transparency, the unfavorable repayment terms, and very high interest rates. I cover a number of things in my written testimony, but among the concerns that we have are around data and transparency. We think, similar to the Home Mortgage Disclosure Act on the mortgage lending side, Section 1071 of Dodd-Frank presents a great opportunity for marketplace lenders to publicly disseminate data on their small business lending activities for consumer protection and fair lending reasons. Let me just conclude by raising the issue that one of the other panelists raised around limited purpose charters for FinTech. We do have some concerns around that. We do want to see CRA extended in the case of limited purpose charters. We also want to make sure that retail lending done by marketplace lenders are examined under those charters. We just have concern about whether that is appropriate in this instance before the great benefits of national charters are extended to these type of platforms. Federal preemption, access to the payment system, there's tremendous benefits from charters being extended, and we want to make sure that fair lending and consumer protections are extended in the process, and CRA. Thank you very much for the opportunity to testify, and I welcome your questions.
Thank you, gentlewoman. Chair now recognizes himself for 5 minutes for questioning. So this is a educational hearing, and so to kind of set the platform here, Mr. Adekar, can you walk me through a typical loan from application to securitization so we kind of get a picture of what this playing field looks like?
Absolutely. So the average loan on our platform, all the loans made through our platform are unsecured consumer loans. The typical loan size is around $13,000, and the typical interest rate is 13.9%. So the way the process works is we market to potential borrowers through a number of sources. We send out direct mail pieces, we do email advertising, we buy search words on Google. We also have some website partners who have comparative financial information sites. There's a number of places through which borrowers come to us. Once they come onto the website, there's an online application process through which, between the information they provide and the information we pull from their credit report, we can instantaneously make a decision for them about whether they qualify for credit and the terms on which they qualify. We present them with the terms that are available to them if they're eligible, and if they decide to move forward, then there's sort of a two-track process that happens. On one track, we then essentially post the terms of their loan application through our website with all personal information anonymized. And the investor members in our website can essentially make a commitment about whether this particular loan is one that they're interested in. This is something that's available to both retail and institutional investors. These days, the demand is such on our platform that most of these requests are essentially fully funded instantaneously. So the sort of funding track is one part of the process. A second thing that's happening simultaneously is this sort of verification process, which consists of a few components. The first thing is we need to verify the identity of each applicant to confirm that identity fraud isn't involved. We also have a risk-weighted employment and income verification process just to confirm the key information related to their application to the extent that incorrect information either in the credit report or supplied by the borrower might increase the risk of default to an unacceptable degree. So that verification process is happening at the same time, and it typically takes from between 3 and 5 days. So once that process is completed, once we've verified the borrower information and are ready to fund the loan, once we've received commitments from investors to fund the loan, then WebBank, who as I mentioned is the bank partner that makes the loans originated through the platform, they fund the loans to the borrower out of their funds. The borrower receives the funds, and 2 business days after the loan is originated, WebBank sells the loans to Prosper. We then resell the loans to our investors. For institutional investors, they buy the entire loan outright. For retail investors, we break the loans into pieces and sell pieces of it of each loan to a group of retail investors, which allows a broader range of folks to participate in the investment process.
So that 2-day period between the time you fund the loan and you securitize or you bring your institutional investor in, so you warehouse that loan for 2 days?
During that 2-day period, it's actually WebBank that retains ownership of the loan. They then sell it to us, and we turn around and resell it to our investors. As soon as the loan's originated, then we're responsible for servicing the loans, meaning we're the ones collecting payments from the borrowers, providing the borrowers information, passing those payments on to our investors, as well as providing our investors with regular reporting on the performance of the loans.
Thank you. Mr. Nichols, how do you envision, I think you you speak to this a little bit in your written testimony, but how do you envision marketplace lending kind of changing the environment in the more traditional banking space?
Well, Mr. Chairman, I'd say, again, our overall view on this is we think partnerships are fantastic and a good opportunity for both. I would say, though, I am optimistic about the future of community banking because of that personal touch. I mean, you have banks that have been operating in communities for decades that, for example, with great respect to the very nice articulation of how those loans are made, it's also good to have a bank that specializes in small business lending so that you can look someone in the eye and get a sense of what the business plan looks like. But I do think, as a general observation, community banks particularly, Mr. Chairman, can really benefit from a lot of these FinTech partnership opportunities. A lot of the larger banks have billions in R&D budgets and in laboratories, and they're doing lots of work. They don't need as much assistance, frankly, as the community banks do. So I think I might have shared this with you, but we've started a task force, Mr. Chairman, at the ABA to really focus, and we've dealt with not only experts within the ABA and in the banking sector, but have really fanned out across the United States to meet with folks all over the U.S. and even probably talk to some international participants to try to find ways where we can specifically help the U.S. community bank market partner with FinTech companies to better serve their clients and customers. And the recommendations, Mr. Chairman, of that task force will be out in the weeks ahead.
Thank you, gentlemen. Now recognize the ranking member of the subcommittee, Mr. Clay from Missouri, for 5 minutes.
Thank you, Mr. Chairman. Mr. Sands, a number of marketplace lenders have opted to operate under the Small Business Borrowers Bill of Rights because they were concerned about the complaints that small businesses have been raising about marketplace lending practices. That Bill of Rights includes a commitment to disclose annualized interest rates, or APR, so that small business owners have a legitimate basis for comparing loan products. But Can Capital did not opt in to the Small Business Borrowers Bill of Rights. Does Can Capital disclose annualized interest rates or APRs to your small business borrowers?
Congressman Clay, thank you for your question. We did not join the Borrower Bill of Rights group initially out of a number of concerns with what that set of principles was capable of achieving and not achieving. Certainly a lot of respect for the intent and impetus behind that group. But candidly, I don't know if Congress people are aware, but that Bill of Rights is selective in terms of the ones that you can sign up for. It's not like 10 Commandments where you have to abide by them all. Can Capital had some concern about the teeth behind it and really was much more focused on trying to do something really palpable and meaningful. And so alternatively, we, with Cabbage and On Deck Capital, formed the Innovative Lending Platform Association, and we're currently sponsoring the SmartBox initiative. SMART is an acronym that stands for Smart Metrics about Rate and Total Cost. The concept of total cost, candidly, is what we've learned in our 18 years of experience is the most meaningful cost metric to small businesses. Small business owners are very focused on maximizing their return on investment. They're focused on the ROI that they will obtain from the use of proceeds. And in our history, we've determined that they really base their decisions on the total cost of capital, which is information that we provide on all the capital products.
Wait a minute. I'm not going to let you filibuster my question. What are your annual interest rates?
Many of our products don't involve interest and don't have an APR associated with them. But maybe to more directly answer your question, through the ILPA and through the SmartBox initiative, we will be disclosing APRs around all products. The initiative is to create a standardized disclosure.
Okay. What was the mean APR of the loans that you provided to small businesses last year?
I couldn't tell you that off the top. I'd have to get back to you with that information.
Okay, don't you think that having objective and comparable information is essential to empowering small business owners to decide which financial products are best for them?
Oh, absolutely, sir. But I would argue that there may be the assumption oftentimes made that APR is the only means of delivering pricing transparency. And what we would tell you from 18 years of operating in the small business finance space is that total cost of capital is a much more meaningful financial metric for our customers, and we disclose that clearly and conspicuously.
All right.
And we will also disclose APR through the Smart Box.
I'm sure other members will have questions for you. Let me go to Ms. Levy. FinTech advocates have pointed to marketplace lending as the vehicle for expanding access to credit for traditionally underserved communities, yet the Department of Treasury report found that virtually none of the loans being made by marketplace lenders were going to the underserved communities of color and low and moderate income communities. Do you think that marketplace lenders are meeting the credit and capital needs of minority communities and other underserved groups?
There are a couple of ways to answer that. First of all, this is one of our issues. We really don't have enough data about how the market is operating. So in the same sense that you have home mortgage, the Home Mortgage Disclosure Act, publicly available information about mortgages and who they're going to, on the marketplace lending side, and just really small business lending more broadly, we do not have that kind of comprehensive data. Now, Section 1071 of the Dodd-Frank Act does present an opportunity to get that data, but marketplace lenders should be covered. Just preliminarily, I would say that marketplace lenders, from our evidence and from some of their annual reports like Lending Club, are servicing prime customers, folks with 640 credit score or above. But it certainly is an issue that would need more information. I will also say that one of our members, Woodstock Institute, did a review of online lenders and found, for example, Can Capital, effective interest rates of between 36% and 60% on, as to your question, your last
Okay,
question.
I'm glad someone could answer my question. Thank you, Ms. Levy, and I yield back.
Thank the gentleman, and now the gentleman from New Mexico, the Vice Chairman of the Subcommittee. Mr. Pierce is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Sands, I think you mentioned that y'all have about $5 billion, more or less, in loan transactions. Do you evaluate where your market share is coming from? Is it new loans that might not have been served, or I'm thinking about Ms. Levi's observations that she's seeing her businesses die on the vine. We're seeing the same thing in New Mexico. So are you going out harvesting new, or are you pulling market share from someone else?
There's some of both, but definitely a significant portion of the small business market that is underserved by traditional financial institutions. So just to clarify one metric, with respect to the $6 billion of capital to which we provided access, some portion of that is in the form of loans, another portion is in the form of a purchase of receivables. It's a true sale transaction. It doesn't entail interest, and that's probably some of the complexity that I was struggling to get through to answer Congressman Clay. That being said, our model was designed.
With all respect, I just wanted an answer to the one narrow question. I've got several more to ask, so I appreciate the answer. Mr. Adhikar, you seem to have thought about the process quite a lot. Where do you see some of the greatest likelihoods of abuse in this system, a high-tech system of quick looks? Just to help us evaluate that, if you would.
The potential for abuse in terms of fraud is something that we take very seriously, and we actually feel.
No, I didn't ask of your feeling on it. What are the greatest risks? Where will they originate from? Because I got some in my mind, and I'll ask you about them if you'd rather, but I wanted to know you were more specialist than me. So I'm sitting here looking, and so the news report today says things that my car is telling the car dealers about me. In other words, you have access to information, and so among that information, you would know my tendency that if I will buy a product or if I'll take a loan at this rate, then why would you give me a better loan? You would fit it there. Do you see that manipulation of data that I think most Americans are frightened by?
I don't see that as being a risk on our platform.
How about you, Ms. Levi? Do you see that as being a problem? You're talking about loans in the nature of 36%, which seems a little bit above the market rate. So the people you advocate see that as being a potential problem, that the access to information on the part of very fast financial analyses would give insights that might affect the rates, or how, or when, or how long?
Yeah, I mean, we have, and I assume you're talking about the information that the lender is receiving and inputting into their algorithms to make the lending.
The CFPB is right now taking information on every human being, 300 million people in the U.S., and if a lender has access to my buying habits, then they can tell everything about me. They know what political party I'm in. They know who I'm going to vote for in the next election. They know what to buy. They know what I'll pay for it, everything, and that's very unsettling that lenders would come into that. Mr. Nichols, you're saying that the banks are glad and willing partners, and that's reassuring, because typically I look at local people as being the connect to keep the abuses out of a system. Tell me if you're contemplating these possibilities of just vast amounts of information being fed to you without even your knowledge. I don't know. I'm just looking for where the system can go wrong and where it needs to be looked at.
Well, I'd just say, Congressman, as a general observation, this issue of protection of data is so important in our new marketplace, with all of the rogue actors out there, with breaches, with cyber. You read about it every single day. So this issue of keeping customer data protected is a critically important aspect of the exercise of any partnership with any type of company of FinTech.
I mean, I understand that, but still you see Facebook, and they would pull down posts by conservatives. They took a political bent, and so even though you have the desire to protect, you still have the Snowdens out there. You have somebody who will sell every single bit of information they get. You get hacking into the system, and I for one, see dramatic possibilities in the marketplace that we're discussing, but I also see some risks. So I don't know. Ms. Levi, you talk about businesses dying on the vine. Do you go to those businesses and say, hey, there's a new platform out here? I mean, do you ever one-on-one talk to people and say there might be another opportunity, don't die? Because, again, that's a problem we face in New Mexico since CFPB is really clamping down. Many people are just not lending as much. So.
Yes, we do interface with small businesses through some of our business centers in providing technical advice, counseling them on how to procure safe and sustainable credit. Absolutely.
Okay. All right. Thanks. We'll yield back to the chairman.
I remind members that votes have started. We're going to go to the gentleman from Georgia, Mr. Scott, for his questioning, and then we're going to recess. I think we have 5 votes, and then we'll reconvene. Mr. Scott, you're recognized for 5 minutes.
All right, thank you. As we all know, with this rapidly changing technology, consumer protection is even more extremely vital, regardless of where the loan is issued, either in the bank or even online. And what I'm gathering from the testimony, I'm hearing from one side that this new online marketplace lending is covered by adequate regulations for consumer protections. But then on the other side, I'm hearing that they aren't enough. So, Mr. Nichols, let me ask you and Mr. Adhikar on what you think are the differences in the type of consumer protection provided by banks versus the type that's provided by a FinTech company.
Sir, there's really one big delta. As the gentleman articulated, all the laws that they're subject to, that's correct. The difference is oversight. Mm-hmm. Because of the supervisory relationship that all these banking regulators have with banks, it's the oversight relationship. That is the key.
Let me ask you, Mr. Nichols, if you would explain thoroughly so everybody understand, when you speak oversight, give us an example so we can be clear.
The relationship the FDIC, the Fed, the OCC, all these entities have with U.S. banks. They have visibility into what the banks are doing in terms of cyber, honoring people's privacy, their data, looking at the safety and the soundness of the institution, looking at systemic risk. The oversight model of the U.S. banking sector is quite defined. That's the big delta at this moment. And that's what I know the OCC is thinking about in terms of if there's going to be a non-bank charter. This is the sort of issue that they're grappling with, is the oversight delta. That is the key difference between the two.
Mr. Adhikar, you concur?
Sure. I would just add that the CFPB has the same enforcement authority with respect to marketplace lenders as it does with respect to banks. Just two additional points. For all marketplace lenders, they're either operating in partnerships with banks to originate their loans or originating directly. As I mentioned, if they're partnering with banks, then they are subject to the supervisory and examination authority of the banks under the Bank Services Company Act. If they are lending directly, then they're subject to the state licensing and oversight requirements of all the states in which they're lending and are subject to examination and supervision by the licensing bodies of those states.
Okay, let me ask the panelists about our small businesses. This is the backbone of our American economy, and data clearly demonstrate that lending to these critical drivers of our nation's economy is still struggling to rebound from the post-recession. So when I saw Treasury, if you recall, in May 2016 white paper, drawing the conclusion that micro business loans, meaning any loan to a small business under $100,000, share the same characteristics as consumer loans, and then suggested that such loans should be subject to the same consumer protections. It got me to thinking, what is the real distinction between these loans? If we hold that these micro business loans to the same standards as consumer loans, what impact is that going to have on businesses gaining access to capital?
Well, first of all, okay.
Yeah, Mr.
Well, I do want to just briefly hit on the examination issue. I mean, there's several marketplace lending models, and whereas traditional banks do come under an examination protocol, I mean, bank examiners go on site, they examine their lending. Under CRA, they examine their lending. Marketplace lenders do not have that level of rigor in terms of examination protocol. And you really have to look at the various models to determine. They may be subject to the law, but whether their actual lending, their retail lending, falls with under supervisory examination protocols of any of the financial regulators or the CFPB really is the pinpoint question. I mean, you've asked the pinpoint question.
Thank you. Mr. Sands, did you?
Yes, thank you, Congressman Scott. I would tell you that a critical difference between consumer and commercial lending is that commercial loans power the economy by enabling growth, hiring jobs, creating jobs, buying inventory, expansion, et cetera. So the use cases for the capital is very different between the commercial and the consumer markets. Also, I would indicate that the distinction in the regulation between commercial and consumer lending has been very sharp throughout the decades. You can see that in the Truth in Lending Act of 1968. And one of the many reasons underpinning that is that when you're talking about small business owners, you are talking about sophisticated users of credit. So just to give you a brief example of the kind of customers that we have at Can Capital, we're not talking about consumer hobbyists, Congressman. We're talking about business owners who've been in business 13 to 14 years, who are doing an average revenue of $1 to $2 million a year. They have brick and mortar locations. They're managing their insurance, their taxes, their payroll, their licenses. These are absolutely sophisticated users of capital.
Thank you.
I thank the gentleman. Have been informed now that what was a 5-vote series is going to be 11-vote series. The good news, some of those will be 2-minute votes. So I ask our witnesses to take a little break here, and this hearing stands in recess subject to the call of the chair. Who is, we have some members that are in the area here. We're going to give other members a 2-minute warning, and then we'll start in 2 minutes. We'll see, as you obviously know, we're in a lockdown. Some members have probably elected to go back to their offices. So just give us a couple of minutes here. We appreciate y'all's patience. That vote series, I think, lasted a lot longer than certainly I wanted it to, and I'm sure it lasted longer than you wanted it to as well. The committee will come to order. We'll now resume questioning and yield to the gentleman from Missouri, Mr. Lukemeyer, Chairman of the Housing Subcommittee. 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here today. I was interested in the last individual's, Mr. Scott's questioning with regards to small business. I guess my question is, I think, Mr. Edarkar, you also do individuals, do you not?
Yes, we only do consumer loans. We do not do small business loans.
You do not do small business loans.
Correct.
And Mr. Sands, you do small business loans and not consumer loans, is that correct?
Correct. We do only small
Okay.
business loans.
So, but both do online lending, right? Okay. Well, both do lending online.
Correct.
Okay.
Correct.
Mr. Nichols, one of the things that you talked about a while ago is, it's interesting because, I was somebody back in 2012, or the 112th Congress, 113th Congresses, both offered filed a bill to have a non-bank federal charter for online lending, and lo and behold, I got criticized excessively for both those terms, and now we're looking at doing this. So I guess I was ahead of my time. That's not necessarily where I'm at most of the time, but anyway, I was on this issue perhaps. You indicated that the ABA would be supportive of non-bank charter, is that right?
If designed properly and thoughtfully, yes, sir.
Do you see an opportunity for banks to get into this online lending?
Well, many banks are already in online lending, yes.
It would seem to me that it'd be an opportunity to expand into a different area, to deliver a different kind of service, offer a different product. I know that you said you're partnering with other people, but I would think that even the banks themselves would maybe look at trying to do this as well.
Yeah, absolutely.
Okay. I assume that that the banks have to comply with all different sorts of regulations. It would make sense that the FinTech companies would be doing the same things, would they not?
In the context, Congressman, of this idea, the concept of a FinTech charter, there are kind of some general principles as we're approaching that, and as we're meeting with the regulators, OCC and others. I think you have a charter because it's designed to serve the public good in some way, shape, or form. So I think if there's level protections, level safeguards in exchange for preemption, which is presumably one of the reasons why there's a desire to be in a charter of that nature.
Do you think that online lending would help you with your CRA rating?
Would it help with the rating?
Yeah, with CRA?
I would answer it this way. I think the idea of, if you're lending in a community, I think the idea of CRA being applicable probably makes sense to banks and non-banks.
If online lenders have to comply with all the regs that banks comply with, do they need to comply with CRA too? Mr. Sands?
Yes, Congressman. I mean, I think that there's a good deal of thought that would have to go into how to structure that. I'm not a CRA expert, but to the extent that we're regulated in the same way, which I would argue largely we are today because of bank relationships.
Mr. Adhikar?
Yes, I think it would depend on the sort of principal rationale that was underlying the bank charter and, the sort of rationale for the supervision, but certainly, the goals of the CRA, to the extent the CRA is intended to promote expanded access to credit, is something that the space is certainly supportive of and believe that we're already being supportive of today.
Mr. Cordray is quoted as saying that small business lending is going to be one of his policy priorities for the next 2 years. And he really thinks the lines between commercial and consumer lending are blurry. Obviously, he needs a different set of glasses. But Mr. Nichols, can you give me a difference between commercial and consumer lending that Mr. Cordray would understand here?
I actually think there are some pretty significant differences there, Congressman, and I don't share the view of Mr. Cordray in this area.
If I could add, Congressman?
Yeah, you deal with one section of it.
Definitely. I would highlight a number of differences. I think in the consumer market, you typically see much smaller balance transactions. I think Mr. Adhikar was indicating that their average transaction is about 13.
What would the CFPB need to protect consumer from in your situation since you deal with business loans?
I couldn't tell you net of the regulations to which we're subject today. I mean, certainly CFPB has some plans for working on the 1071 information gathering regs, but today we're subject to a significant amount of regulation that I would argue provides sufficient protections for small business owners.
It looks like he's trying to get into some place where he's really not necessarily needed to go and probably sure not welcome. But I thank you for that, and I yield back the balance of my time. Thank you, Mr. Chairman.
Thank you, gentlemen. Now the gentleman from Washington, Mr. Heck, is recognized for 5 minutes.
Thank you, Mr. Chairman, and indeed, thank you so very much for holding a hearing on this topic, which I find interesting and timely and important. I'm genuinely appreciative. Mr. Nichols, I want to begin by using this opportunity to remind everyone present. I was inspired by your very evocative use of terms sandbox and greenhouse, and I want to remind everybody that Mr. Posey and I have been working for quite some time on a no-action letter legislation to expand upon what CFPB currently has issued for themselves. And in fact, we've worked with Jess Sharp from your office considerably. He's done a great job, I think, on behalf of your membership. I continue to believe that expanding upon what CFPB initially proposed would be a good and important step forward in this area, and I want to acknowledge that. And then I'd like to ask you to characterize the degree to which you see FinTech as a material competitive threat, if at all.
I don't see it as a threat. I would see it as a threat if the supervisory framework, Congressman, evolved in such a way that they would have some of the benefits and not some of the responsibilities and obligations. For example, in the context of the Congressman's question about the charter, if you're going to have some of the benefits of a charter, you should have the duties and the responsibilities, I think, of being in a charter. So if public policy were to evolve in an unfortunate way, I think there could be a challenge there, directly answering your question. That said, I do see more, if the public policy environment, Congressman, evolves the right way, I see a lot of opportunity. I really do.
I really appreciate that you said that, because I actually see, and I'm not sure I did 4, 6, or 8 years ago, more opportunity for collaboration and partnership here. I'm frankly a whole lot more concerned about things like the Bitcoin and getting outside the payment rails altogether. I mean, you're banking still the backbone of transaction in this economy. Ms. Levi, first of all, thanks for standing up on behalf of people who on occasion need help to be dealt with fairly and equitably. I also appreciated that you acknowledged in your testimony that small business lending was down pretty significantly last year. And I'm wondering if you would briefly characterize, because I'd like a couple of the other people to answer as well, why you think that is and what it is you think we should do about it. Because I see that, again, this whole conversation is about access to capital on behalf of the people who serve as parts of the engine of this economy. And you acknowledge there's an issue here. So why do you think that's going on, and what should we do about it?
Sorry. Well, I think that banks have a responsibility. A lot of the small business lending that has declined is because banks are not providing it, and that, CRA has a role there to play. Some of it is on the demand side as well. There is less demand for small business loans in some regard. There is also a need for about 70% of small businesses want loans under $250,000. Banks are not really interested in being in that line of business per se. They may not deem it profitable. That is also an issue. There are a number of issues. There is a role for innovation, for financial products, for small businesses. But the important thing for us is to ensure that these products come with the full panoply of consumer protection, fair lending examination, and that, for example, a number of the panelists said that CRA should apply, but it is how it applies. Is the retail lending also examined?
Thank you very much. I want to give Mr. Nichols just 15 seconds to...
There's so many interesting statistics here, Congressman. Just today, the NFIB Small Business Optimism Index came out saying that 5% of small business owners reported that their borrowing needs were not met, 5%, and that only 2% of small business owners in the survey sample reported that financing was their top business problem. So there's a lot of really interesting statistics.
So just to clarify, you think the perception that there isn't capital available for small business may be exaggerated beyond what actually exists? Is it fair to surmise that from what you just said?
No, I would say it slightly differently. It's having traveled extensively across the country, it's different regionally based on business models, so I couldn't answer it in a static way like that.
Thank you. Thank you, Mr. Chairman. I appreciate your indulgence.
I thank the gentleman. Now the gentleman from Kentucky, Mr. Barr, is recognized for 5 minutes.
Thanks, Mr. Chairman, and thanks to our witnesses. This FinTech revolution is really quite exciting in many respects from the standpoint of innovation and obviously filling a gap or some demand within the financial marketplace. But as we look and as this marketplace evolves, I think it's important that we strike the right balance. On the one hand, making sure that the existing regulatory regime or the gaps in regulation, perhaps, as some may argue, do not prevent a level playing field on the one hand. On the other hand, I think it's very important that Congress and regulators not overreact to stifle innovation. So I kind of want to explore that tension a little bit with Mr. Sands, Mr. Adarkar, and then Mr. Nichols as well. So some FinTech companies are actually asking for more regulation in the form of a federal charter or federal license. Mr. Sands, I take it you're not very enthusiastic about that concept?
I wouldn't say that I'm not enthusiastic. I would say that there are a tremendous number of details that would have to be explored and vetted thoroughly to understand exactly what the trade-offs are for a company like mine that's strictly a small business balance sheet model. And so commercial finance companies, can certainly operate in the face of the state patchwork. There are certain downsides to that, but whether or not a limited charter would be the answer, I think the devil's in the details.
Mr. Dunker. So sort of echoing Mr. Sands' comments, I guess what I would emphasize is that I do feel that the status quo has allowed a reasonable balance to develop in the sense that the existing regulatory framework, I do feel like, has created a reasonable balance between consumer protection on the one hand and allowing these innovative companies to bring their innovations to market and to grow and to prosper at the same time. And so I would be cautious about a new structure for that reason, just without knowing more about, where the trade-offs would lie.
And if I could please add, Mr. Congressman, I think it's also really important to note that, many of us on the panel here today do work with bank partners, and that, we have established relationships with them through which we have the oversight of the bank itself as well as our federal regulator, and that model works. There have been some recent uncertainties created in that part of the market as a result of Madden versus Midland and other things. Very excited to see Congressman McHenry's bill of last night that would address that.
I think, competition and choice and providing consumers with choices and alternatives is, I think, a hallmark of consumer protection. But I'm curious to know, and maybe this is a question for Mr. Nichols, what is it that is creating demand for non-bank lending that has fostered an environment in which FinTech companies have grown and filled in the gap? Is it perhaps that there are regulatory pressures on community banks, credit unions, other bank lenders that make it unprofitable for institutions to provide consumer credit, small dollar loans, or the products that the FinTech industry, the online lending industry has provided? Or is the risk profile of an unsecured loan in the $10,000 to $15,000 range simply not in the business model of a bank? And that's to Mr. Nichols.
Well, clearly there are regulatory headwinds in the post-Dodd-Frank landscape that banks of varying sizes have been dealing with. There's no question there. I would also observe that a number of the loans, and I think she cited this earlier in her testimony, a number of the loans are refinancing unsecured debt and other things. And to your earlier question, I just wanted to jump in there, if I may. In the context of a FinTech charter, if you're going to get the benefits of a charter, a concept of this nature, I should say, there are duties and responsibilities that would come with that, presumably with preemption. And then the big question, what I think the OCC is thinking about hard here is, again, what does the oversight model look like? That's, I think, the big question. That's what I think Mr. Curry and his colleagues are dealing with. But to your question, there are a lot of headwinds facing banks, particularly community banks, and the regulatory supervisory framework is certainly among them.
I would say that as we look at maybe if there is a need to level the playing field, I think we, instead of having government pick winners and losers, I think we need to look at deregulating some of the areas where we're talking about the Financial Choice Act, these community banks that are unable to actually compete. But in the meantime, we don't want to stifle innovation where the FinTech industry is really providing access to capital where, because of perhaps regulation, the traditional banking model is not able to provide that credit for consumers, businesses, and entrepreneurs. Thank you. I yield back.
I now yield to the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. Mr. Sands, in your testimony, you note that the online marketplace lending industry is varied and rapidly evolving, and that lending models vary based on the nature of the borrower and the mechanisms used to fund the loans. I would also add that many online marketplace lenders offer different types of financing to small businesses, from more traditional loans to merchant cash advances. With this in mind, do you believe that any single disclosure requirement can sufficiently convey useful information in such an unstandardized industry?
Thank you, Congressman. I would tell you that in our experience at Kane Capital, we've found that the simple price ratio disclosure that discloses total cost alongside the basic economics of the transaction, the amount of money being provided, the amount of money that's either the receivables that are being purchased or the repayment amount associated with the loan, provides ample information to the small business owner to understand completely the cost of the capital associated with the product that they ultimately select. What I would tell you, though, is that very much support moving to additional disclosures that not only would highlight the total cost of capital, but that would also reflect the APR of these loans to absolutely create a set of uniform disclosures across all of these diverse products in the space, not only merchant cash advance, but loans of various sorts, some of which use merchant cash advance like payment features, namely where the payment is a fixed percentage of an electronic transaction stream or what have you. That will truly empower small business owners not only to understand the price of the product that they're looking at, which I think we enable today, but also to have an ability to do an apples-to-apples comparison of the different products in the space.
Should there be a tailoring of disclosure requirements based on the unique attributes of the financial products that will be offered through FinTech?
I think there will be the need for some specific disclosures around particular products so that customers are completely clear on how APR disclosures, for example, are made. So, for example, with a merchant cash advance product, which is the purchase of future receivables at a discount, no maturity date, no interest component, no obligation to pay if the business fails, you'll have to assume certain things in order to provide an APR disclosure. You'll have to assume the period of time over which the purchase receivables are delivered. You'll have to assume basically a perfect performance against future expectations of revenue. And you'll also have to further assume that it's a loan product to begin with, which a merchant cash advance is not. That being said, I do believe firmly that an APR disclosure will enable small business customers to be able to compare these different products, even though some of them are not loans and don't have loan-like features.
Mr. Patel, would the failure of a marketplace lender present a threat to financial stability?
Thank you for your question, Congressman. The answer is it depends on a number of factors. One factor is the size of the market, and as I laid out in my written testimony and in my introductory remarks, to this point, the size of online marketplace lending is a mere fraction of the total credit market in the United States. It also hinges on the originate-to-distribute model that is used in marketplace lending, but at the moment, given the nascent stage of the industry and its size, I would say we're a little bit from that conversation being ripe. Feel free to ask a follow-up if you'd like.
I wanted to get feedback on the extent of regulation that's out there right now, because there are critics of the industry argue that it's an unregulated industry and that this supposed lack of regulation opens up participants to significant risks. Specifically, Mr. Adarkar, is the online marketplace lending unregulated?
No, I don't feel that's the case, Congressman. As I indicated earlier, the loans themselves and the protections offered to customers of the consumer loans for marketplace lenders are subject to the exact same framework of protections as any traditional consumer lending program would be. As Mr. Nichols pointed out, the difference is more in terms of oversight at the entity level as opposed to regulation of the loan products themselves.
Thank you, Chairman.
Thank you, gentlemen. Now the gentleman from New York, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, a few days ago, this seemed like it was a few days ago, maybe it was about a week ago, I had the privilege to welcome the OCC Comptroller Curry to my district in Queens, New York, and we went over and toured and visited some small banks in downtown Jamaica. We made some stops at bank branches that had closed, highlighting the challenges that banks are facing today in serving underserved communities and operating in financial industry that is increasing dependent on online platforms. One of our witnesses, actually, Ms. Levy of NCRC, joined us on that tour with the comptroller and took part in the ensuing discussions, and I just first want to welcome you as a member of this panel. Mr. Chairman, for several months now, I've been calling for us to rethink, and I think we do need to rethink on how banking and the Community Reinvestment Act, CRA, should be regulated, because much has changed over the last 40 years since this law was initially enacted. For example, we know that banks have closed nearly 5,000 branches since the financial crisis, and that a great amount of financial services are now occurring through online platforms. FinTech offers both great opportunities to reach millions of Americans and small businesses that are currently underserved, and there's some great opportunities there also. But also, it raises questions and concerns in terms of equal access and consumer protections. So I think that this is a timely hearing and very important for us to have this discussion, because we want to make sure that access is even, and we don't have greater disparities that begin to appear. So I guess my first question is to Ms. Levy, who, since FinTech companies are not covered under the CRA, how can we be assured that the needs of low to moderate income individuals and communities are not left behind?
And we can't without that kind of coverage. I mean, CRA is an affirmative obligation. It requires financial institutions to reach out and provide services, loan products to low and moderate income communities, underserved communities and borrowers. And banks have that affirmative obligations, but there are a number of players in the financial marketplace who do not. And without that affirmative obligation, you do see gaps in the type of products serving that segment of the market, low and moderate income borrowers.
Well, we got to continue to press and look, because I think that, you know, when we look at the wave of the future, technology is just going to be more and more, and we've got to make sure that we're not leaving folks behind. In fact, let me see, Mr. Nichols, let me ask a question. Online marketplace lending is expanding access to credit in some segments by providing loans to certain borrowers who might not otherwise have received it. And I met with some folks today hearing that partnerships between banks and FinTech firms may offer the best model. You have some banks and FinTech firms and they get together. Can you please help us to understand how such partnerships between online marketplace lenders and traditional lenders can help in leveraging technology to expand access to capital and into underserved markets?
Well, you have there's kind of the best of both worlds here. You have the innovation and the technology solution that a lot of these new FinTech companies are bringing to the market, which is fantastic. And then you have what banks, particularly community banks, have, which is the trust and the customer relationship. And it's that pairing, Congressman, that I think is so powerful, and that I think what will help allow us to serve customers, clients, and communities better. I went on and on in the written testimony, but I think it's that pairing. It's trying to bring
Are there any risks, or what risk the bankers fear most or most concerned about when you don't have the FinTech firms, or FinTech firms are operating outside of those kind of partnerships?
We talked a little bit about that, and the way I view that is the potential for risk is that you have an unlevel supervisory arrangement or a supervisory set of arrangements where you have banks subject to a set of duties and responsibilities that are perhaps different than some of the FinTech market entrants, but with the biggest delta, sir, in the area of oversight. And that's what I think the regulators are going to grapple with. So Mr. Adhikar has said a number of times eloquently and correctly that they are subject to the same laws. However, banks in the United States there's an oversight relationship with the regulators that provides remarkable visibility into what banks are doing in a whole host of areas, CRA and dozens of other areas. That's, I think, the future question that regulators need to grapple with properly and thoughtfully.
Thank you. I'm out of time.
I now yield to the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman, and thanks to all the witnesses for your testimony today. I'm a small business owner, have been for 44 years. I'm from Texas. and I'm a car dealer. And I can tell you, since January of '08, Main Street has never hurt as much as it hurts today. I wanted to begin this afternoon by going back to a couple of comments made by Mr. Sands in his written testimony that I found to be of particular value. First of all, access to capital is the lifeblood of small businesses and a major factor of their success and failure. Second, small business owners want to focus on running their businesses, not searching for funds. And finally, and maybe most importantly, all small businesses utilize funds to generate a return on investment. Now, I've said this once, I've said it 1,000 times. I don't know, frankly, how a new business starts or secures capital in this current regulatory environment. I just can't see how it can happen. But new and innovative technologies are expanding lending platforms. In our full committee hearing this morning, we heard from witnesses that confirmed to us that small business lending is down and community banks are consolidating. The very last thing we need is additional regulation that stifles innovation. So I'm particularly concerned when I saw that the Treasury Department suggested we should be regulating small business loans under $100,000 in a similar manner as consumer loans. Now, from past hearings, we've heard how well that has worked out for the consumer loan industry, haven't we? So, Mr. Sands, a question to you. You noted that implementing this recommendation would impact 90% of small business loans. Can you go into greater detail on that topic?
Yes, absolutely, and thank you for those comments, Congressman. We at Kane Capital and within the industry that serves small business are greatly concerned at those comments from certain public officials that loans of $100,000 and less would be regulated in the same way as consumer loans. I mean, especially given, to your comments, sir, that we're talking about 90% of all small business loans in our economy. These are the use cases that small businesses have for smaller balance loans, for shorter-term use cases. And I think it's very important to note that the use of these small business products in the economy is what is truly driving the economy. Oftentimes, the consumer products that we're talking about are for debt consolidation, for consumers with higher FICO scores that are simply, adding no net new capital into the economy. But with the small business products, we're talking about credit that is going to create new jobs, that is used for expansion, to purchase inventory, and to manage cash flows. And one important metric that we follow at my company is the growth of our customers year over year. We're very concerned to make sure that we're helping small businesses grow. In some years, we've seen same-store sales between the first time that we underwrite a customer to the last time equal 4% growth. Sometimes it's been 9% growth. So I think that that's some small indication of what firms like Kane Capital are enabling in the economy. We're a small part of the economy. It's nascent, it's growing, but I think it's serving a critical need for capital for these very important use cases that power the economy.
Thank you. Mr. Patel, question for you. Are there competitive advantages or disadvantages with regards to regulatory structure for marketplace lenders as compared to banks?
So in the current moment, as other panelists have alluded to, marketplace lenders are subject to a suite of laws and regulations that I have made reference to in my written testimony, either directly or indirectly, and I'll elaborate on this for just a moment. Those that partner with originating banks are subject to regulations both from a contractual perspective with their bank partners, if their bank partners are engaging in proper due diligence on the front end, but also via potentially the Bank Service Company Act, as well as an equivalent provision in Title 10 of the Dodd-Frank Act. For those firms, marketplace lending firms that do not use an originating bank partner, they can be subject to many of the federal laws that I made reference to in my written testimony, but are also subject to state licensing requirements and oversight from state authorities in which they are licensed to do business. So the marketplace lenders are, in my view, subject to a wide suite of existing laws and regulations, both on the consumer protection side, the Bank Secrecy Act side, as well as securities laws.
Okay, real quick, Mr. Sines, can you explain how business borrowers and consumer borrowers are different?
Absolutely. Thank you, Congressman. One of the many things that you see, first of all, is a level of sophistication on the part of the small business owner As I indicated before, our small business customers typically have been in business 13 to 14 years on average. They do 1 to 2 million of revenue a year. They have brick and mortar locations. They're managing their taxes, their insurance, payroll, et cetera. These are absolutely sophisticated users of capital. And again, the use case for the capital is very different than a consumer product in the economy. Commercial credit is driving the economy by creating jobs and enabling growth and expansion, whereas oftentimes consumer products are introducing lately no net new capital into the economy. So extremely different use cases, very different product features and uses.
Thank you for your testimony. Yield.
Chair now recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Thank you. Mr. Chairman, we've never had an easier time for blue chip borrowers to borrow money. They're getting it at rates, I mean, there are some governments that are borrowing money at negative interest rates. But I think all the companies that will start in garages this century will be more important to us at the end of the century than the Fortune 100 companies today. If I could buy stock in all the garages, I'd sell the stock in the whole Dow. So we'd all dream of a world in which every entrepreneur can borrow all the capital they need at prime. That world can't exist because 1 out of 20 of those entrepreneurs is going to go bankrupt. And so we need to have a sector of the economy that can lend at prime plus 8. Excuse me, speaking of technology, now we've got the FDIC. Those subject to the FDIC, the depository institutions who promise this guarantee, are going to face substantially more regulation than others. So the question is, who's going to make these prime plus 8 loans? Is it going to be the depository institutions? I've had the regulators here, and I've begged them and implored them to allow banks to make prime plus 8 loans with some small portion of their capital, and they smile and nod, and then they don't do anything. So I'll ask Mr. Nichols, do your members want to make prime plus 8 loans, and will the regulators ever allow you to do so?
Well, the members I represent are...
And when I say a prime plus 8 loan, I mean a loan where that's the fair return given the risk the lender is taking.
I understand. Obviously, I can't speak for all the members. They're not a monolithic group. But, Congressman, as a general observation, allowing market rates to be set, I think, is a general in our nation, and is one of the things that makes our economy.
Do any of your members have a major part of their business or a branch that says, we're lending money to companies that have a 1 in 20 chance of going bankrupt, but we're going to make it up with higher interest rates? Do you know of a major, or do you know of a bank that has a department that does that?
Off the top of my head, Congressman, no.
Okay, and you know the industry pretty well. So there has to be somebody out there loaning money to the companies that have a 1 in 20 chance of being going bankrupt, because those are the only companies that have a 1 in 200 chance of being the next Amazon. And there's nobody in banking doing that, and I don't know whether that's your business model or your regulators, probably both. I'll ask Mr. Sanz, do your members make loans at prime plus 8 and do you make loans to companies that have a 1 in 20 chance of going bankrupt?
Yes and yes, Congressman. The cost of capital to which we provide access is risk-based. We got our start in '98 by designing models that would provide access to capital for small business owners that had less than perfect FICO scores. And we were able to build models that do that based largely on firmographic data that helped us assess the health of the business.
And it's not just the FICO score. I mean, if the pizza tastes like cardboard, the business is going bankrupt.
Absolutely, Congressman. I would tell you that what's important to us, some of the elements that are very important to us as we look at the financial strength of a small business we're looking to underwrite, is their revenue trends, their time in business, Firmographic data.
I would point out that we also have the venture capitalists, the initial public offerings, a host of other means and Reg D, and we've talked Jobs Act, et cetera, a host of other ways of providing capital that expects a much higher rate of return than prime or prime plus 2, and that is willing to take substantially greater risks. I just hope that when the American Bankers Association comes back here in a few years, they say, Sherman, you prodded those regulators, you prodded us, and 10% of our members are having 10% of their portfolios being lent out to businesses that have a 1 in 20 chance of going bankrupt, and we're charging prime plus 8. But you're not there, and somebody needs to be.
Well, one thing I'd say, Congressman, what makes the community banking model in this country so special is that, with great respect to the current evolution of FinTech, a keystroke or an algorithm is never going to replace one person looking another in the eye and say, let's talk about your business plan. Let's talk about your assumptions. Let's talk about your modeling.
And when your regulators let you do that, you should do that.
I understand. I'm saying, but that personal touch, particularly on the part of community banks, is not likely to be replaced anytime soon, in my opinion.
I'll just say, from the standpoint of the business, we'd like to tell you that we love our bankers because of their personality and the confidence they give and the personal relationship. We really just want the money. And while it'd be good to get a loan based on that personal relationship, if we don't get it, we'll deal with Mr. Sands' computer and we'll be just fine. I'll yield back.
I thank the gentleman. And now the gentleman from New Hampshire, Mr. Ginto, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I appreciate you being here today and dealing with our vote schedule in the middle of our hearing. I'm very interested in learning a lot more about the online marketplace. I'm interested in seeing the new innovative and technology platforms that grow and give more opportunities and options to individuals. I represent New Hampshire. We have small business is our backbone. 90% of our economy is driven by small business. We have almost 300,000 people employed by small business owners. And while I think our community banks in New Hampshire do a great job of providing access to capital to individuals, there are those who still have challenges with access to capital, and particularly in part from what I hear and what I'm told by my community bankers are the regulatory challenges of Dodd-Frank. And so that's a concern to me when I then talk to a customer of a bank who says, because of the restrictions, I cannot grow, expand, or start my business. So this space is interesting to me because I think it provides more alternatives and options. But first, I'd like to start with Mr. Sands. And I know that you've covered this a little bit before, but I'm hopeful that my New Hampshire constituents will hear it and appreciate it. If you could just quickly talk about the online small business marketplace and how it actually would provide more access to capital to those individuals that may not otherwise benefit from the existing bank that they have.
Absolutely. Thank you for the question, Congressman. I would tell you that the way in which firms like Kane Capital have expanded access to capital for underserved small businesses is through a focus on technology and data-driven algorithms. I think with all respect to bankers in the banking community that we value, we have a banking partner. It's been difficult for banks to provide access to loans of $250 and less, maybe even $1 million and less to small business because of very high costs of acquisition, search costs, underwriting costs of various sorts. Companies like Kane Capital, we embrace a technology-enabled model that significantly reduces those costs by automating many features of the underwriting process, by building data-driven models that take certain inputs and provide some significant insight into the current and future financial health of the small business and their eligibility for loans and their ability to pay. So by relying on technology, building data-driven models, and candidly over 18 years, amassing data about those transactions, those daily interactions with customers, developing very deep insights into hundreds of different industries that enable us to identify like customers almost instantaneously and predict their future financial health and underwrite them on that basis.
So given the fact that we've had 800,000 fewer small businesses started during the last several years nationally, which is where I think we can point to a problem with economic growth and a problem with wage inequality, or the term that I hear, wage inequality. There's less job opportunity and availability when you have 800,000 small businesses that have not been created that should have been. So that's why, to me, I think that there's an opportunity here for greater access. One thing I wanted to ask Mr. Adeker, I'm also concerned about either the unbanked or the underbanked and how this can provide greater access to that space and that community.
Thank you, Congressman. We believe our platform expands access to credit by reducing the cost of credit, as a result of the combination of innovative technology as well as operational efficiencies and the sort of focused expertise we bring to our particular product. We believe we'll be able to price our borrowers at a rate that more accurately reflects the cost of their credit, and in that way, we believe that we're able to expand access.
Okay. Well, I appreciate it. Thank you all for
Chair now recognize Mr. Pittenger for 5 minutes.
Thank you, Mr. Chairman, and thank each of you all for your endurance and patience today. My first business in the 1980s, I had to borrow $150,000 from a banker, and he knew me and I knew him, and I was very fortunate to get the loan. He was paid back. We had a good mousetrap. We had a good idea. And some years later, I was asked to join a community bank board, and this was during the 90s. And from the time we chartered the bank until the time we sold the bank to a mid-sized banking institution. And, we knew who to loan money to. I was kind of the PR guy, and we had a lot of golf tournaments and cocktail parties, and we're a relationship. And they knew us, and we really knew them. And we went in our loan meetings, there was a box we checked on character, and we knew those folks. I don't see a box on character today that you check, and that entrepreneur has been the lifeblood of our economy. That's what has made America so unique, that people come to America for opportunity and to take their idea and their dream, their vision, their work ethic, their risk, and to build something. And now I believe our entire economy is really threatened for the long term because an entrepreneur doesn't have a place to go. And I think that's the greatest challenge we have in the future. So as one who believes in markets and open markets and free markets and competitive markets, I am grateful for choices that we have in the marketplace that allow someone to identify their cost of capital, prime plus 8, whatever it is, and they fit that in their model. And if it works, it works, and they go off and run. So I applaud the work that's being done and the effort and the tenacity and the genius of folks who get out there to create something that's really needed in our economy today. With that in mind, Mr. Sands, I'd just like to get an understanding. There's a lot of conversation that your business is not regulated, yet I've read in your testimony in the appendix a broad matrix of applicable laws and regulations that you have to respond to and comply with. Could you outline some of these existing laws and that you've got to comply with and give us a framework of what you have to be accountable to?
Absolutely. Thank you for the question, Congressman. So today in our business, we're subject to multiple layers of federal and state regulation. We act both as a direct lender. We also have a relationship with a partner bank. And as a result, we're subject to rules and regulations, for example, regarding fair lending at the federal level, ECOA and Reg B on the commercial credit side. We're subject to both federal and state laws regarding unfair and deceptive acts and practices, the various other laws that we set forth in the appendix. And importantly, we're subject to an additional layer of regulation through the relationship that we have with our bank partner. That results not only in being subject to the oversight of the bank's own federal regulator, the FDIC, but also to the bank itself, which entails requiring a robust compliance management system, regular third-party audits by reputable audit firms, as well as approximately quarterly audits by the bank itself for compliance with the credit policies, all compliance policies and procedures under AML, BSA, FICRA, et cetera.
Thank you. Give me a better understanding of how business borrowers and consumer borrowers are different.
I'm sorry, sir, I didn't hear.
Business borrowers and consumer borrowers. Tell me
Thank you,
the
sir.
distinction between the two.
Thank you, sir. I appreciate it. What we see in our business absolutely is a number of things. I've said before, I hope you don't mind my repeating, one major difference is the use case for the capital. What we see in the consumer industry is consolidation of debt at somewhat lower prices. What we see on the commercial side of the ledger is that capital is being used to drive the economy through the creation of new jobs, expansion, remodeling, managing cash flow issues. We also see in our customer base a very high level of sophistication. Business owners like many members of Congress that have been here today, namely people who have been running businesses for decades, who are managing revenue in the millions of dollars, who are accessing capital for $50,000, $100,000, $150,000, as you indicated, Congressman, to drive their businesses forward. So very different uses and significantly different profiles in terms of the user.
Thank you. I yield back. My time is up.
I think, gentlemen, you ask unanimous consent that one Democrat and one Republican have one mini round here, and with that, I will yield to 5 minutes to the gentleman from Georgia for additional question.
Okay. Thank you, Mr. Chairman. I want to make sure I get some clarity on where everybody stands regarding this May 2016 letter that the Treasury Department has put forward. And I started on that before the last session. And the paper made the conclusion that the micro business loans, any loan to a small business under $100,000, share similar characteristics as consumer loans and should be subject to the same consumer protection. So I think we need a clarity answer from each of you all. Do you all, who agrees with this conclusion? The marketplace lenders, if I'm correct, you're currently regulated under the Truth in Lending Act, is that correct? Anti-money laundering and the Fair Credit Reporting Act, but you are not under the same level of scrutiny as the traditional banks. Is that where we are? I mean, am I correct there?
Congressman, so I think I would distinguish between marketplace lenders engaged in consumer lending versus those engaged in small business lending. And my point earlier is that for marketplace lenders engaged in consumer lending, the regulatory framework is the same as it is for traditional bank lending programs.
I would like to add, the bottom line, whether it's $25,000, $100,000, whatever the size of the loan, the bottom line is that marketplace lenders should be subject to things like the Equal Credit Opportunity Act, the Fair Credit Reporting Act, not only subject to, but examined under. This lending has to be supervised and examined in the same way that depositories are examined. And if they do not comply with fair lending laws and regulation, those products really should not be in the marketplace.
Well, Well, the other point I want to get at is that as we are bouncing back from the recession, perhaps the most targeted group that is struggling the most to get access to this credit are African Americans. Am I right? Does anybody disagree with that?
It certainly is what you see in the HMDA data.
Yeah.
There's been a tremendous drop-off on, certainly where we have data, you do see that.
Right. And so the issue becomes, can we get any indication from you all as to which way we should go here in Congress to get a more even playing field, to try to figure out why there's this inability, particularly with the African American community, to get access, and particularly because that's the community that desperately needs this wealth building process in this community to start a new business, which many want. Hire a new employee to get themselves lifted up.
Well, let me say this. The fact that you do not have affirmative obligations like CRA for non-bank lenders.
Explain when you say affirmative action.
In other words, bank depository institute under CRA, they have to be affirmatively reaching out, outreach, providing products and services to low and moderate income borrowers in community. It is an affirmative an obligation that requires that they take step forwards. Non-bank institutions, by and large, do not have those kind of affirmative obligations on them. So if you don't have that, you're going to see some gaps. And let me just say this, also not having fair lending reviews is a problem. Let me give you an example from the bank context. We've seen 15 instances in the last few years of large redlining settlements, consent orders as a result of direct supervision by CFPB, HUD, and state attorney generals. You have to be reviewing the lending to ensure that it is fair and equitable to low and moderate income communities, minorities, rural communities, and the like.
Okay. Well, I see my time is up, Mr. Chairman. Sorry.
I thank the gentleman. My last question is, when marketplace lending started off kind of peer-to-peer, then we started having some institutional investors come in, then we've seen securitization. And so I guess the first question is some people kind of have said that the current economic situation and the policy of the Fed has got a whole bunch of people out there looking for a lot of yield. This was a perfect storm where the marketplace lenders came in, were able to provide an opportunity for lenders to get, for investors to get a higher return and for borrowers to get a lower interest rate. Going forward, how do you sustain your business model where the economic conditions, one, change, and secondly, interest rate environment changes? Somebody want to pick that one up?
Thank you, Congressman. I would tell you that with respect to Can Capital, we don't sell any of the assets that we originate. We're a balance sheet model. We retain all the risk of all of the assets that we either originate or that we buy from a bank partner, and we rely on lines of credit from lenders. We don't have future flow arrangements. We're not originating to sell. And so I don't know that with respect to my business's model that I could directly address your question because we're not a marketplace lender in that sense.
Okay, Mr. Adhikar.
Sure. Thank you, Mr. Chairman. What I would say on the investing side of our business is a significant portion of the investors on our platform, whether they're retail or institutional, are value-driven, and they're attracted by the risk-adjusted returns in our product. So in that sense, I do not believe that a change in the interest rate environment would change the value they saw in our asset relative to other, the risk-reward trade-off in comparable asset classes. On the borrower side of the business, our most typical borrower is someone who's refinancing higher interest credit card debt. So for those folks, we would expect that rates, the competing rates they were seeing in that sector were sort of moving in line with the general movement in interest rates overall. So we do not expect that a change in the interest rate environment would hurt that side of our business either.
Mr. Chairman, I'd say obviously banks are looking for some interest rate normalcy, as just an aside. But one of the advantages here of being a bank is you have the stable funding aspect, and that banks will be there for you in a credit or an economic downturn, which is certainly of advantage of the U.S. banking system in the context of your question.
And so then what we've heard a lot of discussion today about is, looking at what kind of regulatory environment the marketplace lenders need to operate in, which what we've seen happen to our friends in the banking industry is we saw more regulation put on them, change their business model. So if the regulatory environment gets more aggressive in the marketplace lending, what's the likely outcome of change? Will you have to change your business model, and will that change your funding model as well? Mr. Adekar?
Sure. What I would say in that respect is, with all due respect to Mr. Nichols, I believe that what's driven the success in our space is not necessarily a difference in allocation of regulatory resources so much as it's our ability to develop innovative technology, our ability to create operating efficiencies, and our ability to focus and develop product expertise in a very specific area with a very particular type of product to a degree that would be difficult for most traditional banks. And so I do feel like there are certain inherent significant competitive advantages that explain the great bulk of our success that would still be present in a different regulatory environment. Of course, any new regulatory scheme, we'd like to see it applied in a way that was balanced and fair across the spectrum of lenders and in a way that didn't overly stifle innovation. But we don't believe that regulatory change would necessarily go at the heart of what we see to be our competitive advantage.
Mr. Patel, Madden versus Midland funding, how's that ruling going to impact marketplace lenders?
So I would say Madden has been a source of uncertainty in this industry. Frankly, the Madden case, the resolution of it is still uncertain. There are a couple of issues to be decided on remand by lower courts.
Can you talk a little bit more into your microphone there for me?
Can you hear me now, sir?
Yeah.
Great. Sorry. Madden has been a source of uncertainty. The resolution of the case is yet uncertain. There are a couple of issues that need to be resolved by the lower courts, specifically the application of valid when made and choice of law issues. But more to the macro point on Madden, Madden creates uncertainty as to whether or not interest rates charged on certain loans are valid, and thus whether those loans comply with a series of legal requirements, including state usury laws, potentially even federal RICO laws. So on the whole, this is one reason I would expect that certain FinTech companies are advocating on behalf of a national charter of some sort, whether a bank charter or something more limited, because they want to quell some of the uncertainty created by the Madden decision, which frankly, depending on your read, is distinct from Court of Appeals cases in other areas of the country.
Well, I want to thank the, I'm sorry.
Yeah, if I could, Mr. Chairman, I'd like to introduce for the record this letter of July 11th from NAFCO, National Association of Federal Credit Unions.
Without objection, so ordered. I'd like to thank our witnesses for your testimony today, and without objection, I would like to submit the following statements: a statement of the Financial Services Roundtable. We have the credit union and the report from the Financial Innovation Now. Without objection, all members will have 5 legislative days within to submit additional written questions to our witnesses, and we ask the witnesses to forward their responses back to us as quickly as we can so we can get those to the members. Also, Without objection, all members will have 5 legislative days within to submit extraneous material to the chair for inclusion in the record. Again, I thank our witnesses for your patience, and with that, hearing is adjourned.